Hello everyone. In this video I'm going to be walking through an example of a Monte Carlo analysis problem where we're going to look at a retirement problem and we're going to determine the likelihood of achieving the desired outcome from someone who is retiring based on their investments that they're making, how much their drawdown is every year, or their expected drawdown every year, the current value of their portfolio, and their goal, which is to not leave debt for their heirs. Okay, so I'm going to be working through a spreadsheet, but before we do that, I wanted to go through some information that's in the spreadsheet to kind of explain some other things that we're looking at. So in this example, we are considering two investments that the investor has. They can invest in a risk-free asset, so think of something like a money market fund or U.S. Treasuries, and a risky portfolio. So this would be a portfolio of stocks and maybe some bonds, but there is risk involved with this second investment, the risky portfolio. By definition, the risk-free asset has a standard deviation equal to 0. So if the annual return for the risk-free asset is 4%, then that's the return that the investor will get on that. So again, using as an example a money market fund that is FDIC insured. If the quoted return on that fund is 4% a year, then that's how much money, that's the return, that the investor will get on that. It's not going to deviate from 4%. If I buy a U.S. Treasury today, and it matures in 1 year, and let's say the rate of return on that, or the yield on that investment is 4.5%, I will receive a 4.5% return absent some huge national catastrophe happening where the government can't make good on its promise. Okay? So that's what a risk-free investment looks like. It has a stated return, and that's the return that you're going to see. There's no deviation. There's no risk or volatility involved with that return. The gross risk-free return. So when I say a gross return, it's 1 plus the return. It's modeled for each time period as the exponential constant raised to the power of the risk-free rate multiplied by delta t, where R sub f is the periodic risk-free rate and delta t is the length of time for the period in years. And in our example, we're looking at annual periods, so delta t is just going to be equal to 1. So you'll notice I don't have a value in there in the formulas that we put in Excel for delta t because it's just equal to 1 for us. The risky portfolio does have some risk. It has an expected return and a positive standard deviation that is provided in the problem, and we'll go over that when we get to the problem. The periodic expected return is denoted as ERP, R sub P. The gross return for a single year, and this gets a little complicated, is the exponential constant E raised to the power of the expected return for the risky investment minus 1/2 or 0.5 multiplied by the variance of the risky investment multiplied by delta t, and again delta t in this case is just 1, plus the standard deviation of the risky investment multiplied by z multiplied by the delta t, and again delta t is just equal to 1 here, so this last thing is just the standard deviation multiplied by z. The standard sigma p is the standard deviation of the risky portfolio, and z is a random number from a standard normal distribution. So I'm not going to go into a lot of the theory here. This is well covered in a lot of places. I recommend the 5th edition of Financial Modeling by Simon Benninga, the textbook that I use for this material. Chapter 23 goes into a lot of detail about where this value comes from. But in general, what we're looking at is a random walk with drift. Okay, so the drift part of it would be the expected return. Okay, the random walk, the volatility or the likelihood of getting an outcome different than expected comes from the idea that random things happen. So when you think about a stock, you might have a company that has a product with some problems with it. So product liability issues where, if you're a car manufacturer and you have recalls, if you're a food manufacturer and you have problems with things like E. coli or listeria, if you are a hardware manufacturer and suddenly there's a section of your business that really takes off because of something that is happening in the environment that wasn't expected. Okay, so random things happen with companies all the time, and those things directly impact their stock prices. And so when we look at stock prices and we look at stock returns, they're not just smooth lines, they move around a lot. And that's because new information is being reported in the media about these companies, and investors then take that information and they determine how that's going to impact the future earnings and cash flows of the company. And then that has a direct impact on the returns and the price of the investment. Okay, and so that's what we're seeing here. The Z is a random number because random things happen with companies. So that's where that comes from. And again, I don't want to dig into the math too much here for that, where all the calculations where we get this value, but there's a lot of great sources. I mentioned one earlier. Chapter 23 of the financial modeling book by Simon Benninga. That's the 5th edition. So to get the value of Z, we use the Excel functions norm.s.inv and rand. The norm.s.inv function returns the inverse of the standard normal cumulative distribution, and the rand function returns a random number that's greater than or equal to 0 and less than 1. So it's between 0 and 1, and it's evenly distributed. The complete formula used to get the value for Z is equals norm.s.inv, open parentheses rand, open parentheses, close parentheses, and then the close parentheses again. And I will show you in the spreadsheet how to do this. Okay, so let's move on to the spreadsheet now. The spreadsheet looks like this. We've got some information here. So what we have is a current portfolio value of $1 million. So we're getting ready to retire. We've got $1 million in the bank. The risk-free rate is 4%. Mind you, there's no standard deviation here because, again, it's a risk-free investment. The expected annual return is 9%, and that's for the risky investment. The standard deviation of that return is 20%. So the proportion invested in the risky investment, so we have to divide up the wealth of the investor between the risk-free asset and the risky investment. Okay, so in this case, what we're saying is we're going to put 70% in the risky investment and 30%, 1 minus this amount, in the risk-free investment. What we want to do is draw down our retirement value at $150,000 a year. In other words, we want to be able to spend $150,000 a year, and we expect to live for 10 years. It's kind of dark there, but this is how we do retirement planning. At some point, people die, and so what we want to figure out here is, if we live for 10 more years, can we achieve our goal here? Now, we don't hate our heirs. We don't want to leave them with a whole bunch of debt. So we want to figure out whether or not we can achieve our goal of living on $150,000 a year given these inputs. The things that we cannot change. We can't change the risk-free rate. It's not up to us. We cannot change the expected annual return for our risky investment or the standard deviation of that return. That's not up to us. We can change the proportion invested in the risky investment, and we're going to take a look at that. And we can change the annual drawdown. Okay. So what we're going to do here is we're going to model out the possible situation where we have 10 years. We're going to look at the returns that we earn on the risk-free, the potential returns that we get on the risky investment, and then the effect of drawing down $150,000 a year. And at the end, down here, the ending balance of wealth, what we want to see is that this is a positive number at the end. Then what we're going to do is we're going to simulate 1,000 different tries at this, okay, because there is some randomness involved. And we're going to see what percentage of the time we die with a value, our ending wealth value, being greater than 0. Okay, so let's go ahead and take a look at that. So the first thing I want to do here is to make my life a little bit easier. I'm going to name some of these cells. I don't really need to name the first cell here. I'm only going to use this value once, but I am going to need to use this second risk-free rate multiple times. So I'm going to name this cell risk-free. Try that again. Okay, there we go. I'm going to name my expected annual return. So this is the risky investment. I'm going to name this risky return. And you can always name it something else if something else makes more sense to you. I'm going to name this risky standard deviation, risky STDEV. I'm going to name this prop risky. So it's my proportion that is invested in the risky investment. And then finally, I'm going to name my last one here, the annual drawdown. I'm just going to name this drawdown. So doing this saves a little bit of time and makes some of the calculations a little bit easier. So the wealth at the beginning of year one, day one, I have $1 million. So I'm just going to set this equal to my current portfolio value. And then the invested in risky, I'm going to put in here equals proportion risky, prop risky here, what I just named that. You can see that that brings up this cell here, multiplied by my wealth at the beginning of the year. Invested in the risk-free is equal to the wealth at the beginning of the year minus the proportion invested in risky. The random normal variable, this is the one I was talking about. The Z is the variable I was talking about in with the document. So here I'm going to put an equals norm.s.inv. And then I'm going to put in rand, open parentheses, close parentheses, and close parentheses again. Okay. So whenever you hit enter there, hopefully you got a different number than what I just got. And the reason being it's a random variable. So if you're getting the same number I am, there's something probably a little off there. It shouldn't happen that you get the same random variable that I do. So don't worry about that if you're not getting the same random variable here. 1 plus the return on the risky investment, that's that long equation that we were looking at. So let me pull that up again so you can see that. So it looks like this. We're going to put in here equals in Excel, it's EXP. EXP, the expected return on the risky portfolio minus 0.5 multiplied by the variance of the risky portfolio, so the sigma squared. plus, and remember again, these delta t's are just ones in our example. So it's 1 year, so we don't need to put a value in there. You could multiply all this by 1. You're not going to get any different outcome though. Plus the standard deviation of the risky investment multiplied by that z that we just calculated. Okay, so I'm going to go back to the spreadsheet here. I'm going to put in equals exp, open parentheses, my risky return here, minus 0.5 multiplied by the standard deviation of my return, my risky standard deviation there. Let me pull this over so you can see that better. And we want to square that value. So that's our variance. And then we would take that multiplied by that delta t, but again, that's just going to be 1, so there's no need to do that. Then I'm going to add to that the risky standard deviation, multiplied by the z value we calculated here in F12. Okay. I'm going to close my parentheses there. It's a big old Excel formula there that we've got. Double check, that you've got the right formula in there. Now I'm going to press enter. So what we see here is that we get a value of less than 1 because we get a negative value here for our random variable. What this means then is that the return is actually going to be negative for the year for our risky portfolio. The wealth at the end of the year is the combination of our investment in the risky portfolio multiplied by our return for the year, plus our investment in the risk-free portfolio, or excuse me, risk-free asset, multiplied by the risk-free rate. Okay. So let's go ahead and do that. I'm going to put in here, I'm going to start with the risky investment. So I'm going to put the amount invested in risky D12 multiplied by my 1 plus the risky investment plus my amount in the risk-free multiplied by, and here is where we're going to use the calculation for the return on the risk-free portfolio, which is EXP, open parentheses, the risk-free rate. And we name that, or I name that risk-free up here. You can see that. And again, we would normally multiply that by the delta t, the length of the time period. But in this case, again, our delta t is just equal to 1, so I'm not going to put a value in there. So that is our formula for the wealth at the end of the year. And you can see when I pressed enter, it changed my random variable. You can turn that off. I'm not going to do that right now, though. Again, you should be getting different numbers here. What matters right now is just making sure you get the right formulas in. Our drawdown is equal to, and I want to put drawdown in here because later on we're actually going to change this variable, and we want this to change for all of our years. And so my ending balance of wealth is going to be equal to my wealth at the end of the year minus my drawdown, H12 minus I12. So my next year, and so that fills up our first row. I just need to fill in the first number of the second row, and then I can drag everything down. So I'm going to set this equal to my ending balance of wealth. So you can see here, this value is equal to that value in column J. And then I'm going to highlight the rest of my cells there, not including the value in cell C. And I'm just going to bring it down by 1. And then once I do that, I can highlight all of these in row 2 and bring it down to row 10. So what we see here, it looks really good. What we see here is that we are currently ending up with $1.106 million at the end of our time periods. I'm just taking a look through here to make sure everything looks okay. Everything's flowing as it should. So yeah, that is a great outcome for us at the end of 10 years. We're drawing down at $150,000 per year, and we end up with 1.106 million in my situation here. Yours should look different. So, but that, doing this just one time doesn't give me a lot of confidence. What I want to do is I'm going to try this many times, and this is where that Monte Carlo simulation comes in. Okay, so what we're going to do is we're going to run this simulation here 1,000 times, and you could do it much more than that, but for our example we're just going to go for 1,000 times. So that's what I'm going to do over here. I'm going to create 2 columns. One is my simulation number, the second is the ending balance of wealth. Because remember, what I want is for there to be a positive number when I die in 10 years. Got it all planned out. Okay, so I'm going to put in 1,000 different simulations here. I'm going to drag this down to 1,000. Takes a second here. And then what we're going to do is we're going to use a data table. The data table in this case is a little bit different than what I've done in the past. In this case, our column input cell is just going to be a blank cell. Because we don't have a singular variable that's changing, we just want, because we've got some random variables in there, we just want to run the simulation 1,000 times. So I've got my counter there for my number of simulations. I'm going to put in my first row here for my data table. I'm going to put in here equals my ending balance of wealth at the end of 10 years. So in this Excel workbook or worksheet, this is cell J21. So at the end of the 10 years, how much money is left? This counts as our first simulation. You saw when I pressed enter there, it recalculated all those random variables and it ended up with a negative value that time. So we're going to run this simulation 1,000 times. I put my cursor in L12. I'm holding down the Shift key and the right arrow. And now I'm going to hold down the Control and Shift keys and press the down button to highlight all of my 1,000 different simulations. So now I'm going to go to Data, and I'm going to go to What If Analysis and Data Table. There's a row input cell. There's no row input cell here. The column input cell needs to be an empty cell, and that might sound a little bit weird, but we don't want this to reflect any changing variable in our simulation counter. Okay, so it's just a random cell that is blank, and it's going to stay blank. You don't want to put anything in this cell. So I'm going to choose P2 here as my column input cell because I'm not going to put anything in that cell later on. I'm going to press OK now. It's going to take a second. So what's happening is for each one of these cells here, for each simulation, it's calculating everything in this table to get the outcome that we see here. And just to make it look nice, I'm going to format this as currency. So you can see here there's a lot of negatives, and I don't like that. Okay? I don't like that because that means I'm not achieving my goal of not leaving debt for my heirs. I just, don't want any big problems, big bills for someone else to have to potentially pay. So what we're going to look at here is the average, the sigma, whether or not the bequest, which is, my estate that's left over when I die, whether or not that's positive or negative, and the percentage of time that it's positive. Okay. So I'm going to put in here equals average, and I'm going to highlight my values for each of my simulations. So I put my cursor in cell M12. I'm going to hold down Control Shift and press the down arrow to highlight all of those. And I'm just going to put a close parentheses here. And so it's showing me my average outcome is negative 29, 250, 288. I don't like that. Again, I don't want a negative outcome, and now it's changed again because you might notice this depending on the speed of the computer that you're using. I've got an okay computer here, but it takes a minute to do 1,000 simulations of this table. So you'll notice I'll press enter, and then a little bit later it catches up because it's doing the best that it can to calculate my outcomes. We're going to use the same set of information to calculate the sigma or the standard deviation of my outcomes. So I'm going to put in here equals stdev.s. It's a sample standard deviation of my outcomes here. I'm pressing again Control Shift and the down arrow. I'm going to close the parentheses there, and it's going to update too. So you're going to notice that it updates. The standard deviation is quite large. Okay, I'm just giving it a second here. The standard deviation is quite large. So that means, if you think of a standard normal distribution, there's a 68.4% probability that the outcome, the average, it will be one standard deviation from the mean, either way. So you've got a negative outcome here and a big sigma. So there's a large variation in the outcomes. So in the next one, cell, these are the ones that I really care about here. I don't like that it's negative. What I want to see though is how often do we end up with a non-negative outcome when I die in 10 years. I'm just going to drop in after 10 years, what's left over. So here I'm going to put in the function equals countif, open parentheses. I'm going to put in my range again being all of my potential outcomes here. And then I'm going to put in a comma, and then I'm going to put in quotation marks. And my goal, what I want to see is how often is my outcome greater than 0. So I'm going to put here equals, or excuse me, not equals, the greater than a value there, and then the number 0, and then I'm going to put in quotation marks again and then close parentheses. And so this will calculate the number of outcomes that are positive. And now I want to know the percentage of the time that my outcomes are positive. So I'm going to put in my last cell here equals my number positive divided by 1,000, because that's the number of simulations that I have. Okay. Press enter. Again, it's taking a minute because it's calculating everything. So my percent positive is 37.1% of the time. I'm not happy with that. I don't want the likelihood of me dying and leaving at least something other than debt to my heirs of only being 37%. So now this is where I would go through and change some of my variables that I have the power to change. Again, I don't have the power to change how much money I have. If I'm retiring today and I have $1 million, I can't add to that. I can't change the risk-free rate. That's not up to me. That's up to the Federal Reserve or the government or someone else. I can't really change the expected annual return on my risky portfolio. If I want to increase this return, that would necessitate a riskier investment. And that would actually also increase my standard deviation. And that's something I might be able to look into. However, it would make this number, the sigma, even larger. Okay, so a greater likelihood of variation. I don't really want that. What I can change, what I can impact is the proportion invested in my risky investment and my annual drawdown. So let's see if I go a little less risky, if this has a big impact on my answer here. So I'm going to go from 70% down to 60%. And again, need a second here for it to catch up. I'm just waiting another second. Yeah, there we go. So actually what we saw here is when I did that, it decreased my outcome of having a positive outcome. So that's not looking good. I'm just going to double check that. I'm going to go down to 50%. And that's even worse. So no, I don't want to decrease the proportion of my risky investment. Now, my percent positive before was about 37%. And as you're working on this, you should be getting similar numbers. They won't be exact. Okay. If we wanted to get even more similar numbers, we would go for 10,000 different simulations, but that would, depending on the computer that you're on, that could take a while. Okay, so we're going to stick with 1,000 here. Decreasing the proportion invested in the risky investment did not improve our outcomes. I'm going to go back to my original outcome, and before it was giving me about 37% of the time. So I'm, again, just going to give it a second here to catch up. There we go. All right, so in this case, it's not 37%, it's 35.7, but still kind of in the same ballpark as what we got the first time. Now I'm going to increase my proportion in the risky investment to 80% and see what happens. All right. Well, that was a little bit better. Okay, that gave me a little bit better outcome there. But still not great. Still, there's less than 50% chance that I'm going to leave some money to my heirs. Now, the average here is positive. However, that is likely due to some outliers because, again, our median would not be positive because more than 50% of the time we're ending up with a negative bequest. I'm going to just crank this up to 90% just to see what happens to my outcome. And they're not a big change, okay? I didn't see a big improvement from 80 to 90%. So I'm going to go back to 70% here because it looks like what I need to do. And you might notice that sigma is also climbing as I add percentages to my risky investment. I don't want that either. Okay, so I'm going to go back to my 70% and I'm going to see what annual drawdown I can afford because it looks like I'm just living too big or expecting to live too big for 10 years and I need to draw this down a little bit. So let's take this from $150,000 to $100,000. That looks a lot better. Okay, so instead of saying I'm gonna live, I'm gonna pay out $150,000 a year for the next 10 years. If I live a little bit less, I can increase my positive percent there. And again, my numbers are probably going to look different than yours, and they should, but they shouldn't be vastly different. Okay. I'm looking at a positive percent of 88.8%. Now, when I've worked with investors and organizations, we have to recognize that unless we're extremely, and honestly, probably a little too conservative, we're not going to get to 100%. Okay? We're taking some risk. We want to spend money because we're using the money for good things and things that make life better. So we want to use, a meaningful amount of money. So depending on the investor, you may want to have this percent positive be a little bit lower, where they can plan on going a little bit higher in what they can pay out. Because understanding that, we're not locked in to $100,000 a year, okay, or $150,000 a year. We can make adjustments later on. We just don't want to dig too big of a hole that we can't get out of. So I'm going to use as my goal here 75%. So I want to get a 75% outcome here. So that means I can increase my drawdown. If I'm not changing any of my other variable here, I can increase my drawdown. So I'm going to increase this to 125,000 and see where I get with that. If that gives me around a 75% positive outcome. That's a little bit lower, okay? So I'm going to try it's slowly catching up. So that's a little bit lower than what I wanted. I wanted about a 75% outcome. So now I'm going to lower my annual drawdown again to see if 115,000 gets me where I want to be. Okay. That's a little bit closer. If I wanted to, and I'm just going to give it a second here. There we go. That's what we wanted. Okay, 75.8%. I might run this scenario a few more times just to be comfortable with that number. So I'll just try it again. Another way to rerun the scenario is, depending on the keyboard that you have and the operating system you're using, is to press F9. That doesn't work for me on the setup I have right now, so I'm just re-putting in the number. It's going to recalculate the outcome. Should recalculate the outcome for me. There we go. And again, I get a 76%. So what I'm doing when I do that is I'm rerunning this scenario 1,000 times. And so I'm just getting really close to that 75%. So I'm happy with this outcome of saying my annual drawdown is going to be 115,000. I get a percentage positive, or a likelihood of achieving my goal of having a non-negative outcome at the end of my 10-year life after retirement. I'm getting that close to the 75% I want. So this is what I would kind of be happy with. Okay. I hope that this is a helpful video for you. Please let me know if you have any questions.